Hey all, this is the advanced entering video part 2. In this video we'll be going over the third type of entering into the Forex market, and it's called, and which I call the break below or break above. Okay, so let's get into it. Basically, first of all, let's go over the two different styles that I've actually shown you in this video series. The standard one, which is enter about 9 pips below, which is something like that. Say this is this bearish signal here, bearish engulfing. Right, identify bearish engulfing. This is the standard entry that I show you in the majority of the trading videos. Okay, on the other video, in the advanced entering video, I show you how you can enter on a 50% retrace. Okay, now that doesn't happen all the time, but when it does happen, it can actually offer a nicer risk to reward because you're risking less. Okay, it does also reduce the probability with the 50% retrace method. Now the third option I wanted to go over in this video, right, and is a very, very valid way of entering the market, is the break below or break above. Now let me just show you this in detail. Say, okay, let's look at this identified signal first off to begin with, and we'll go through all the signals and I'll show you exactly how to do this. Right? In this method, what you do is you enter below the signal entry and below the wick. And only if the market breaks below there are you interested in taking a sell trade. So once you get a signal, you would place your order below the pin, a few pips, just like 3 or 4 pips below the pin. Doesn't have to be much. Right? That way you know, it gives you that added benefit of knowing that this is a possible trend move, because in a trending situation, the break below or the break above will continue to happen, right? Until that break above or break below is broken. So this is the first initial break below, and it's commonly an area also where people have their stops. So this method does increase the probability of your trade. However, it's a two-sided coin. It also means that you are risking more pips when you're taking a trade. Now, it's not always the case. Let's look at this one, which has virtually no pin on it whatsoever. This is a bullish signal, and this would be your entry level, just above the signal, right? Look at this line. This would be your entry to buy, and as you can see, there's not much of a pin. So the entry coincides with our major, standard way of entering, as well as a break above. Yeah, and so this gave a really, really valid signal. And as you can see, there would have been some stops right above here, and the price went higher. And like I said, this does increase probability. I'm not sure how much it increases probability. It probably increases probability by about maybe 5 to 10%, if that. However, you will find commonly in the Forex market that once price breaks below, it keeps heading in that direction. Right? So this is definitely an advanced form of entering, and it's definitely a valid form that I want to add in this series. Right? So now you have 3 forms of entry. You have a retracement method entry. You have the standard entry where you enter about 8 or 9 pips below the body, whether there's a pin or not. And then you have this one, which is an option as well. Now let's have a look at a couple more trades. This is a sell signal right here, bearish engulfing. So you'd want to only enter if it breaks below. Let's see, the market retraced, came up, and finally it broke below here, and then it went down. Here's another example of a bullish engulfing candle here at support. This is previous support from the past. Price went, you would enter a buy above if it breaks above here, and it did, and price went up higher. Now, because you're risking more pips, this is an optional form of entry. Yet, you'll see when I go over a couple of the charts in a moment how this can be a high probability way of trading in the Forex market. Okay, so let's keep going. Here's a sell signal. This would be an entry to sell. Your stop is still in the same places, of course, guys. And you can go over the video parts. You're just placing the stop above. You still need to put the stop in the place above. It's just adding a little bit extra risk because of to get a little bit higher probability. Basically where we're taking out people's stops. And as you can see, commonly with these areas, when price breaks above, right, so this is an entry candle here. When price breaks above, it tends to keep going in that direction. Good signal, break above or break below, and price keeps going. Okay, so let's have a look at a couple of pairs, a couple of different time frames, so you can get a bit of an idea of this advanced entering method. Okay, so here we're on the AUD US 4 hour, and this is where price broke below and then came back and tested this as resistance. This is a daily resistance zone. Okay, so I'm on the 4 hour just to show you how, as you can see, we were previously at a resistance zone back here. Came back and retested it and gave a nice bearish signal right here. It also gave a nice bearish signal right here, right? But with the only sell as it breaks below, which is what we want to see, it didn't break below. Yeah? It also gave a couple of nice price action signals below here, and we did have a break below here, and as you can see, the price went down. In fact, it went down 57 pips. Right? So it showed that the break below worked in this instance once again. Okay? However, let's look over here where we've got this nice, valid, significant engulfing candle. It's a nice A-grade trade with the engulfing trader strategy. And as you can see, if we took a break below here, we wouldn't have been entering the chart, entering the market until multiple candles later. Okay? 1, 2, 3, and then as it hit this level, there was a bit of sideways action, and then price just fell apart. Price went lower. Now, commonly what happens is when it actually hits these zones, these break belows, the price just keeps heading in your direction. Okay? So let's have a look at another pair because of the stops being hit. Now, this is the 1 hour on the New Zealand US, so I wanted to give you guys a few different time frames to just show this in detail. Here's a bearish engulfing, which we want to see at a daily resistance zone. Price has come up to this resistance zone. Okay, right, come up. Now it's coming back down. Gave a nice bearish candle, so let's mark that in. Right, now we want to enter with this advanced entering style. We want to enter below, and see this is an easy way, an easy method of entering, and definitely a recommended way of entering on the lower time frames as well, because you know, risking a few more pips for a higher probability trade is always worth it. And this method gives you that little extra bit of probability because it's taking out some stops. As you can see, some buyers would have had their stops here. Yeah? And so they were taken out. And as they were taken out, price went down. Bearish engulfing, price went down. You can see that I offered an excellent risk reward. As you can see, let's have a look at this trade. This was an entry. This would have been your risk up about here, about 53 pips. And the market went down 128 pips. Even if you took it to a one-to-one, getting out of one of your positions, right? Taking the 2-trade method, we'll go over in part 3 of this video series. You would have taken a one-to-one around here, which was previous bottom structure, locked in the other trade, and allowing it to run until you got a nice bullish engulfing, which didn't happen until about here, giving you pretty much exactly a 2-to-1 on this trade, on the second position. Okay, and entering with the advanced break below method, or break above if it's a bullish signal, but this is a bearish signal. Okay, so let's have a look at another pair. Okay, this is the Euro USD. So let's have a look at a signal here. Okay, first of all, we had a bearish signal back here. So let's mark that in. Bearish engulfing. Not a bearish engulfing, right? Bearish engulfing here, yeah? So, let's have a look at this. Price went down, yeah? Bearish engulfing. But did it break the low? Did we go break below low? This is where you'd enter if you wanted it to break the low. Actually about here. It's all good. You'd know that some stops would be here. As you can see, this was an example of a non-retrace move. So even entering on the standard method would have been fine. Okay, like I said, this just increases probability. Even though you might seem like you're getting in late, that increase of probability is there because it's hitting other people's stops, and because when markets are trending, they always continue breaking the low or breaking the high as they're moving. And so you want to see that initial move of a break of the low or break of the high. And that's where this advanced method of trading is very effective. First of all, we know the engulfing candle is breaking the high or breaking the low in the first instance. So when it breaks the high and breaks the low again, for an entering method, it does give an extra edge of probability, and that the market is more likely to keep going in your favor. So let's have a look at this, right? Let me get rid of this line first off. That's a bit... Okay, so where you'd enter is about here, just below the pin, right? And bam, so you want it to break below to show you that the market is trending in that direction, and it did. Broke below, gave nice risk to reward. As you can see, this was a previous... Was it a previous bottom area? Let's have a look. Oh, yeah. It was a previous area. Like, it's a bit of a zone. It was actually, like, about here on the daily charts. Yep, so it's a bit of a zone like that. Okay? And they gave a nice risk reward. As another signal, we can look at another signal. We didn't know this was a resistance just here, so let's have a look at price moved along. Okay, well, let's have a look at another pair, and we'll see if we can see a break below on that as well. As you can see, if this was a major resistance though, at that time, this is a major resistance now, more so. If this was a major resistance at that time, a break below, price went down. Okay, let's go to the GBP US, and let's have a look at a couple more signals, just to give you an idea of the break below method. Okay, so here's the GBP US. Now this is a resistance zone that goes way into the past. Right, identified resistance zone. Right? And as you can see, we had a nice bearish engulfing here. And so what you can do, and this is one that would be valid in the standard method as well as the break below method. Right? Now let's have a look. Here's another one here. Another bearish engulfing at resistance as price moved back here again. Oh, right here. Sorry. This candle here. And then you wanted to break below, and price came along sideways, didn't break below straight away, and then it broke below and it moved lower. All right. Here's an example of this is a confirmed support, a bullish engulfing. Right, and you want to enter with this advanced entering method. You want to enter above, which means it's hitting people's stops, and then the price went up. Right, so it just gives that little bit of an extra filter. It does mean more risk, guys. So overall, let's have a look at this just for a moment. All right, like I said, let me go over it again. In the standard method, we just enter about 8 or 9 pips, you know, below or above the signal, right, whether there's a body or wick. Okay, it doesn't really matter. If there's no wick, it's even better, right, because it coincides with this advanced entering method. The other method I went over was the 50% retrace, which I said to you guys isn't as high probability as entering below, but it is an advanced entering method because it allows us to risk less pips and we've still got the signal, and it can work really well when it works. And like I said, it doesn't always retrace the market. So when it retraces, it's a good one, but if it doesn't retrace, well, that happens sometimes. As an example, you can see a little bit of a retrace on this bullish engulfing. Okay, so, and this third method, which I'm going over, it means risking a little bit more pips, but it means making your signal a little bit more higher probability. And so they're all good methods overall, and they all work really well with the engulfing trader strategy. And this is a third form which, you know, is a very valid way of entering the market. And in particular, if you're entering on the lower time frames, this is a recommended way of entering the market in general. Like if you're entering on the 1 hour or lower, right? You can just include the pin in your price action and enter below or enter above. And it means that you're taking out some stops in the process. And because it's just such an added little bit of extra pips to risk, it's not such a big deal, because you're getting the, like I said, you're getting the benefit of higher probability when you're using this method. Okay, well, thanks for watching, guys, and once again, happy trading.